Hi there. Expanding your business brings important property decisions. Here's how home working and business parks compare. For UK tax and business rates,
When an established business owner looks at a $14,400 yearly lease for a commercial office, that number rarely reflects the actual cash leaving their account. The true after-tax cost is closer to £9,257. Growing firms often reject external office space because they look strictly at the gross headline rent. They calculate the monthly cash outflow and decide it is too expensive compared to working from a spare bedroom. Welcome to Atlas Tax Advisors. Today we are analyzing the tax and rates rules for the 2026-27 UK tax year to determine the actual financial difference between working from home and signing a commercial lease. This property decision dictates your business's corporation tax relief, your personal income tax, your exposure to business rates, and the capital gains tax status of your primary residence. We will calculate the net cost of an external office, identify the specific tax rules regarding home office deductions, and break down how HMRC rules can lower the cost of a commercial lease. Evaluating a property move requires looking past the monthly invoice to trace those costs through your tax return and find the after-tax cash impact on your business. Working from home is permitted by HMRC, provided you follow one foundational rule. Any expense you claim must be incurred wholly and exclusively for business purposes. For self-employed sole traders, there are two ways to calculate this deduction. The first is the flat rate simplified expenses method, which requires no receipts and is based on the hours you work. Under the 2026-27 rates, this flat rate provides £10 a month for 25 to 50 hours, scaling to a maximum deduction of £26 per month if you work over 100 hours at home. It is simple, but for most established business owners, it produces a lower deduction. The second method is the actual cost apportionment. This generally yields a higher tax deduction because it allows you to write off a fraction of your household running costs, including mortgage interest, utilities, council tax, and your broadband internet. This fraction is calculated using the floor space of the specific room you use for business, multiplied by the percentage of time it is used for work. Because this method yields a higher annual deduction, business owners often try to maximize it by claiming a specific room is used 100% of the time for business. This triggers a specific rule regarding the sale of the property. When you sell your main home, the gain in property value is normally sheltered from capital gains tax by the principal private residence, or PPR, exemption. HMRC applies an exclusive use test. Rooms used exclusively for business lose PPR protection. If a £300,000 property doubles in value, you have a £300,000 gain. A 10% home office places £30,000 outside the tax shelter, creating a $7,200 tax bill when sold. This capital gains penalty upon the sale of a home can offset 10 years' worth of incremental income tax savings gained from claiming the dedicated room. If you operate as a limited company, the compliance rules for working from home change. You cannot apportion your household bills the way a sole trader does. The most straightforward route for a director is to have the company pay a flat working from home allowance of £6 per week. This provides £312 per year tax-free and requires no receipts. To claim higher actual costs, a director must execute a formal rental agreement between themselves as homeowner and their limited company as tenant. The company can deduct the rent it pays you, but that amount becomes taxable personal property income on your own self-assessment return. If this rental agreement grants the company exclusive use of the room, you face the same principal private residence risk as a sole trader. The alternative is leasing a commercial office. Unlike residential space, the full commercial office rent is deductible as a business expense. For a limited company with profits between £50,000 and £250,000 in 2026-27, deductions fall within the marginal relief band. Here, the effective marginal corporation tax rate is 26.5%. Every £1,000 your company spends on office rent reduces its corporation tax bill by £265. You can also offset the cost of moving into that office by utilizing capital allowances, specifically the annual investment allowance, which has a £1 million limit. This allows a business to deduct 100% of their qualifying office fit-out costs immediately against their profits in the year those costs are incurred. Next, we must consider business rates. Many owners assume that signing a commercial lease automatically results in a high local authority tax bill. For many small offices, this is not the case. Under 2026-27 rules, small business rates relief is tied to a property's rateable value. If you secure a small office with a rateable value under £12,000, you qualify for 100% relief. Securing a unit below that £12,000 threshold eliminates your business rates liability, which lowers the expected cost of the move. You must verify if a commercial landlord has opted to tax the property, which means they will charge VAT on the rent. If your business is under the £90,000 revenue threshold and you are not VAT registered, you cannot claim that VAT back. Failing to verify the landlord's VAT status means a 20% increase on your rent that cannot be recovered. This changes the net cost of the lease. Let's apply this logic to our starting persona, a sole trader consultant earning £80,000 a year, deciding whether to leave their home office. Assuming no VAT, the gross annual lease is £14,400. Sitting in the higher tax bracket yields a 42% relief rate, effectively deducting £5,760 from the lease cost. However, leaving the house loses their home office deduction, adding back £617 in forfeited tax relief. After accounting for tax relief and the lost deduction, the net cost of that office is £9,257 per year. Because the business now operates from an external office, the owner ensures there is no exclusive business use of their house, preserving their principal private residence exemption in full. Combining annual income tax deductions with the protection of the PPR exemption ensures the commercial office remains a tax-efficient choice over the long term. Actual cost deductions for home offices look efficient on an annual return, but claiming exclusive use creates a capital gains liability upon the sale of your home. Commercial business park leases involve higher headline costs, but income tax deductions and small business rates relief reduce the final cash impact. These tax factors should be weighed against business requirements like staff productivity, client perception, and work-life balance. This video provides general guidance based on 2026-27 UK tax rules. Tax liabilities depend on your specific business circumstances. Meticulous record-keeping and the correct structuring of commercial leases or director rental agreements are necessary to remain compliant with HMRC. If your firm is growing and you need to review your property tax strategy, contact Atlas Tax Advisors today. You can reach us by phone at 07404 427 275 or email info@atlastax.co.uk. For more business strategy and tax analysis, subscribe to the channel. Thank you for watching.